All right, guys, welcome to the channel. Every week I come on here and I break down what's actually happening in the Philadelphia real estate market. Not the watered down version, not the headline grabbing stuff, but the real data, what it means, and what you can actually do with it, whether you're a buyer, seller, or just an agent trying to figure out how to better serve your clients. My name is Andrew Polini. I am the brokerage team leader at Keller Williams & Power, the number one real estate brokerage in Philadelphia by units sold, total volume, market share, all of that kind of fun stuff. But I'm in this market every single day, whether it's with my clients, with our agents, and I want to come on here every week and break down to you guys what I'm seeing. But before we get into it, I would really appreciate it if you go down and you hit that subscribe button. I'm building this page from scratch, and I would appreciate all of the support that you guys can provide me with. I would genuinely appreciate it, and I'll definitely make sure to give you guys a shout out. But I want to come on here every week and just provide a resource for anybody researching the Philadelphia real estate market. But let's get into it. It's the first week of July, middle of summer, and there is a lot going on. And we're going to start all the way at the top because the entire housing market, nationally, locally, basically rises and falls on one thing. That's mortgage rates. At the end of the day, most people are financing homes. They're borrowing money, and the cost of borrowing that money determines how many people can actually afford to buy, which determines demand, which determines prices, inventory, all of it. So right now, the 30-year fixed is sitting around 6.5%. Let me pull it up. So the question is, what actually controls mortgage rates? Because I hear people talking about this all the time. The Fed's raising rates, the economy's so bad, yada, yada, yada. It's a little bit more nuanced than that, and I want to break it down in a simple way for you guys to understand. So there's four things that impact mortgage rates. The first, it's the 10-year Treasury. This is essentially the heartbeat of mortgage rates. The 30-year mortgage rate basically follows the 10-year Treasury wherever it goes. The 10-year Treasury is the interest rate that the U.S. government pays people to lend them money for 10 years. So investors feel confident about the economy. They pull money out of bonds and into stocks and riskier assets. This causes bond prices to fall, yields to go up, and mortgage rates to go up with them. But when the economy looks shaky, everybody runs to the safety of government bonds, so yields fall and mortgage rates come down. Right now, the 10-year Treasury is at 4.5%. So the 10 years at 4.5%, mortgage rates are at 6.5%. Why is there a difference? And that's number two, which is the mortgage spread. So that 2% gap from the 10-year Treasury to mortgage rates is the mortgage spread. This is what lenders charge on top of the 10-year as their profit and to cushion risk. Historically, the spread has been around 1.6 to 1.8%. If you go all the way back, right now it's at 2%, which is slightly elevated from historical averages, but it's still not bad because if you go back to 2023, the spread hit almost 3%. If we still had that spread today, your mortgage rate would be closer to 7.5%. So the fact that spreads have tightened is quietly one of the best things happening for buyers right now, and I'm not hearing enough people talk about it. The third thing that impacts mortgage rates is inflation. This is the one that you guys feel every single day, whether you're tracking it or not. Gas is expensive, groceries are expensive, everything costs more money than it did a few years ago. The Federal Reserve, their goal is to keep inflation at 2%. Right now, we're closer to 3%, depending on what metric you're looking at. And until that number comes down, the Fed's going to keep financial conditions tight, which keeps upward pressure on rates. There's a lot impacting inflation right now, but obviously the biggest one is global conflict, what's going on in the Middle East. When energy prices spike, and they have, everything that moves, ships, or gets manufactured gets more expensive. That feeds inflation. So the situation, what's going on overseas, it's not just a headline. It's showing up in your grocery bill. It's showing up in your interest rate for your mortgage. And the fourth thing is economic data. Every month, the government releases data on the economy, job numbers, GDP, consumer spending, and the market reacts in real time. Last week, the June jobs report came out at just 57,000 new jobs. That was at about half of what economists were expecting. If you go back to May, we had 130,000 new jobs. So we went from 130,000 to 57,000 in 1 month. That's a big drop and something to keep an eye on. Here's why this matters for you and why you should keep an eye on it. Weaker job numbers signal that the economy might be slowing down a bit. And when the economy slows down, it takes pressure off of inflation. Less inflation pressure means that the Fed has less reason to keep rates high. And that can eventually pull rates lower, but we're not there yet. And the jobs number is a crack in the wall worth watching for all of us. The person that I would tell all of you guys to follow is Logan Matashami from Housing Wire. He tracks this every single week, and he's been right all year ever since I started to follow him a few years back. But his current view is rates are going to stay in the 6.5, 6.75 range for the foreseeable future unless something big shifts in the data. So now let's talk about real estate. Let's look at what's happening nationally. Inventory is climbing. There are now about 852,000 single-family homes for sale across the country. Demand is holding. Mortgage purchase applications, how many people are actually applying for loans to buy a home, are up 5% compared to last year. We just hit 21 straight weeks of that number being positive year over year. So people are still out there trying to buy despite rates being at 6.5. Demand has not collapsed. People are out there looking for homes. So the bottom line is rates where they are right now in the mid sixes, still creating a slow but steady environment in the real estate market. If for some reason later this year they're in the low sixes, then I could see things opening up fast. But we definitely want to keep an eye on where they're heading and make sure that they don't go closer to 7%, because that's when things are really going to slow down. So now let's zoom into the city of Philadelphia, because this is where things are really going to get interesting. Philadelphia is not like the rest of the country when it comes to the market. The Northeast, there's always going to be a growing population. Demand is always going to be there. But I hear it constantly from clients, from agents, that the market feels weird right now, and I get it. And I want to show you guys exactly what the data says and why it feels that way. Let's look at home sales first. So far in 2026, there have been 6,600 home sales in the city of Philadelphia. At this point last year, we were just above 7,000, so roughly a 4% drop year over year. For more context, 2024, there were 7,000 sales. 2023, there was closer to 7,300. So sales have been trending down gradually, and every agent in the city feels it. But there's also some good news out there as well. Pending sales, homes that are currently under contract, tells a slightly different story. So last month, there was 950 homes that went under contract in Philadelphia. This is up from 2024 and also 2025, where we had closer to 900. So pending sales is a leading indicator. It tells you what is about to close. And right now that number is up. So buyers are active. So why does this market still feel weird? Here's why. This is, to me, the biggest reason that there's such a split in the market right now and why agents are feeling all over the place. Inventory. Right now, there are over 5,700 homes for sale in the city. So according to Bright MLS, this is the highest level of inventory on record. Last year, there was 5,200 homes for sale. 2024, 4,900. 2023, there was 4,700. More homes for sale means there's more competition between sellers. And in theory, you would think that this would push prices down because there's more supply than there is demand. But that's not necessarily what's happening, because when you zoom into Philadelphia's neighborhoods and you go zip code to zip code, the inventory story looks a lot different. In the most demanded neighborhoods, the ones where buyers are looking at the most, inventory is actually down in almost all of Center City. Fairmount, 20% down from last year. Old City, Society Hill, down 20%. Fishtown, down 15%. Rittenhouse, Logan Square, down 15%. South Philadelphia, down 14%. But if you look at other parts of the city, the Northwest, Conshohocken, Manayunk, Roxborough, inventory is up 70%. The Northeast, inventory is up 20%. So that's what's driving the overall numbers to be higher. Inventory growth is concentrated in areas where buyer demand is soft, but the hot neighborhoods here in Center City, buyers still have very little to choose from. And this is something that I say to every single person that I work with, that Philadelphia is not one market. It's very, very neighborhood to neighborhood, zip code to zip code, and sometimes block by block. The data that matters the most to you depends entirely on where you're looking in the city. I specialize in Center City and the core neighborhoods, but when somebody calls me about Manayunk, about Roxborough, about the Northeast, I'm connecting them with an agent who lives and breathes that market, because they're going to do a much better job for that client than I would. That's something that I will always stand for, is that anybody that ever reaches out to me, I will make sure that you're connected with the best of the best locally in the neighborhood that you're looking to either buy or sell. So I want to go a little bit deeper and look at days on market, because there's some really telling data when you look here. And you're going to see that there are essentially two markets running at the same time in the city. The first market is homes that are actually selling, because they're still selling fast. On average, homes selling in the month of June went under contract in 2 weeks or less. When the right home hits the market at the right price, buyers are moving immediately. But the other market, homes that are sitting, they're averaging right now 50 days on market. So what's the difference between a home that's selling in 15 days and one that's been sitting on the market for 50? Pricing and presentation. Every single time. Right now, half of all active listings in the city of Philadelphia have already had one price reduction. Half. That means a huge number of sellers came in too high, watched it sit, and had to drop their price. And here's why that's a problem, because beyond the obvious, when a home sits and cuts prices, buyers are going to start wondering what's wrong with it. It stigmatizes the listing from the rip. When I work with sellers, I always talk about the 3 pricing approaches. The first is shoot for the moon, list it high and hope. The second is pricing it at market, right where the comps say you should be. The third is going to be the price to generate demand, slightly under the market to drive multiple offers. Options 2 and 3 are where you want to be. The goal isn't to list your home for the most money. The goal is to sell your home for the most money. Those are 2 completely different things. The first 2 weeks on the market mean absolutely everything right now for exposure, for demand. So if you're not seeing showings, if you're not getting serious interest within the first 2 weeks, then you probably have a problem, and you probably have a pricing problem. But let's actually look at those prices, and this might surprise you after everything that I just said. Prices are up. The median sales price in Philadelphia in June 2026 was $315,000, which is up from $295,000 in May and up from $300,000 this time last year. Think about what that tells you. Homes are selling in under 2 weeks. Prices are higher than last year. It's not a weak market. That's a market that's rewarding great homes that are priced and marketed correctly. There's limited good inventory out there, plus real buyer demand is creating higher prices in Philadelphia. And that's exactly what we're seeing. So let's just recap what we just talked about. Sales 2026 versus 2025 are slightly down, but pending right now in June, July is up, which means the pipeline is building. Inventory is at record highs citywide, but down significantly in the neighborhoods that buyers are searching in. The market is split. Great homes that are priced right are flying, and overpriced or poorly marketed homes are sitting. That's why prices are going up. Philadelphia, it's still a very strong real estate market. It just rewards the people that know what they're doing. Moving forward, I'm going to be bringing on some of those top professionals that know what they're doing. We're going to talk about strategies, how they're pricing homes, how they're working with buyers, and how they've built massive businesses here in the city of Philadelphia. But that's my recap, what's happening first week in July. If this was useful, or even if it wasn't, do me a favor and hit that subscribe button. Share it with somebody thinking about buying or selling. Drop any questions that you have in the comments. I'm going to read all of them. I'm going to respond to all of them. And I'm going to give all of you guys that subscribe a special shout out. If you're a buyer or seller that wants to discuss a specific situation, just reach out to me. I'm going to put my email address in the description below. And like I said, my goal is to connect you with the best local professional here in the city of Philadelphia. But thanks for watching. I will see you guys next week.